Again, I bid you good afternoon and welcome. This subcommittee on domestic policy of the Committee on Oversight and Government Reform will come to order for its first meeting. This is the first hearing of the subcommittee, and it's also the first hearing in a series of hearings on the state of urban America. The series intends to take a closer look at American cities, their progress, their problems, and their future. This series is important not only for the problems it seeks to rectify, but also because I think the last time the United States government took a comprehensive look at American cities was nearly 40 years ago when the Kerner Commission concluded, quote, "Our nation is moving towards two societies, one black, one white, separate and unequal." Today's hearing will examine the subprime mortgage industry and the problem of foreclosure, the payday lending industry, and the enforcement of the Community Reinvestment Act. The hearing will also examine alternatives to foreclosure and to payday lending. Next Thursday, March 29th, we'll look at urban economic development strategies, and particularly whether taxpayer-financed stadiums and large convention centers fulfill the economic promises made about them. In the coming weeks, we'll also take a look at the retail and grocery store industries, as well as access to health care in the heart of urban America. Today we're examining the impact of foreclosures, predatory mortgage, and payday lending in America's cities against the backdrop of a serious plunge in the stock market last week. On March the 13th, the Dow Jones Industrials dropped more than 240 points, its second biggest drop in nearly 4 years, primarily due to the subprime mortgage industry. All three major stock indexes dropped by about 2%. The stock market erased $406 billion in wealth. By the end of the week, nervous creditors forced New Century Financial Corp., the nation's second largest subprime mortgage lender, to stop making new loans. As the stock market recovers from a bruising week and the anxiety about what is to come, major American cities are bracing themselves. The Center for Responsible Lending projects that 1 out of 5 subprime mortgages originated during the past 2 years will end in foreclosure. These foreclosures will cost homeowners as much as $164 billion. The exact cost they will have on urban America is unknown. I wonder if any of us in government has a proper understanding of the dimensions of the forthcoming foreclosure crisis and the impact it will have on American cities. It will be severe, it will be prolonged, and it will be very serious. Today's hearing is meant to examine what has brought us here. What are the motivations and practices of the lending industry that brought them to the verge of a financial crisis and brought American cities to the edge of downfall? For the record, I've invited leading trade associations for mortgage brokers, payday lenders, and the American Bankers Association to help us answer this question. We thought they were all going to be with us here. I'm disappointed to learn that 2 out of 3 associations invited reconsidered their participation in the hearing. Now, Cleveland, my hometown, is at the epicenter of this national problem. I want to point to some maps here with the help of staff. You look at this map. You see the sideways lying V highlighted in light green. Let me tell you what that geographical area represents. It is the area in the city where depository banks made very few prime loans. Now this map, highlighted in red and orange. Look at the same V and the same place. This geographical area represents where the highest number of subprime mortgage loans were made during the same year. Now, this next map, again, the same V and the same place. Here the red dots indicate the number of foreclosures. These maps tell you there is a clear and self-reinforcing correlation between the low number of prime loans, the high number of subprime loans, and the high number of foreclosures. And finally, the final map. Again, the familiar sideways lying V shape. But here the foreclosures, indicated by blue dots, are superimposed on the neighborhoods. Red indicates predominantly African American neighborhoods. Again, a match. Lack of access to prime loans, a high frequency of subprime loans, and a high rate of foreclosures are by no means specific to any racial group, but this pattern certainly carries a whiff of America's dark past. I started my political career as a representative in the Cleveland City Council. Later, I was clerk of courts and then mayor of the city of Cleveland. During my tenure as mayor, Cleveland became the first city to sign a Community Reinvestment Act agreement pursuant to the then newly enacted Community Reinvestment Act of 1977. But that's what happened to my city in the past but what's happened to my city in the past decade is a story that is reflected nationwide. Consider a recently published report on 7 of the nation's largest financial institutions entitled Paying More for the American Dream. The report found that Citigroup, Countrywide, GMAC, HSBC, JP Morgan, Washington Mutual, and Wells Fargo all originated a substantial volume of both higher-cost subprime and lower-cost prime loans. The report also found the following. For these 7 lenders, the percentage of total home purchase loans to African Americans that were higher cost was 6 times greater than the percentage of higher cost home purchase loans to whites. I'll go over that one more time. These 7 lenders, the percentage of total home purchase loans to African Americans that were higher cost was 6 times greater than the percentage of higher cost home purchase loans to whites. And those percentages were actually 41.1% to 6.9%. Next point. The percentage of total home purchase loans to Latinos that were higher cost loans was 4.8 times greater than the percentage of higher cost home purchase loans to whites, 32.8% to 6.9%. In each of the cities examined, the 7 lenders combined showed larger African American white and Latino white disparities than those exhibited in the overall lending market. Foreclosure and discrimination in lending practices. These are serious problems for America's cities. But in almost every major city, there are significant numbers of hardworking Americans who are working to reverse these problems. Among our distinguished witnesses today are some of those Americans. These are individuals and organizations who have created viable alternatives to payday lenders and to foreclosure and subprime mortgages. These alternatives are the link between where we are now at the brink of a massive wave of foreclosures to where we want to be, on the road to the nation's recovery, where American families can live in security, physically, emotionally, and financially. But even with these alternatives, even if these hardworking Americans work every second of the day, the tide will not be turned, because the magnitude of the problem outstrips even the best of their abilities and efforts. To turn the tide of foreclosure in America's cities, leadership at the federal government level is necessary. Today we'll have the opportunity to examine what the problem is and the steps that can be taken before it becomes bigger and beyond our capacity to resolve. So with that, I would like to recognize the distinguished ranking member of the committee, my friend from California, Mr. Issa, for his presentation.